Good morning, everyone. My name is David Moore. I'm with Equity Advantage, and today's presentation is titled Today's 1031 Real Estate Solutions. Give your investors a place to go. And we're going to be covering a lot of stuff that we've been through before and used. So when we get the examples at the end, we'll be talking about things that actually have been done previously in times. I don't know, I actually have never had a time like this before, but in recessionary times, things that we can do to help people get stuff going. Also, some things that are unique to today's situation. We'll talk briefly about the 1031 extensions. I'll mostly leave that in the text there, but some housekeeping real quick. There's a bar off to the right side. We're not going to be entertaining live. You're not seeing me for some reason. Let me see what's going on. See if it comes up now. I guess if nobody sees me, it's no big deal. You might like that better anyway, but we'll see what's going on with this. And it's not going to impact the presentation anyway. I don't know why it shows me on my screen, but I'm not seeing it out there. Don't you love today's modern problems? Anyway, so there's a bar on the right side. It has a section for questions. If you've got questions, don't hesitate to just type out a question on there. I see Carol says asking if it's been started, and now she says she sees me. So it's good to see people are seeing what they need to see. But we've got an hour here. The only dumb question is the one you don't ask. We're here to help you. If it's not something we're covering during the presentation, don't hesitate to reach out via email or give us a call. Ideally, calls are best. We can get through stuff very quickly. But the main thing is we're going to talk about some things that can hopefully help people get through the situation, talk about what we're seeing in here, some of the movement we've got going on. I think the thing that really is at least inspiring to me at the moment is people want to do things. And it's just a question of whether we can get them there. On some of the larger transactions, we're having some issues with financing, and we'll talk about what's happening there. But on the bright side, people want to do things, and so we're not sitting dead in the water like last time. Business is down, but the phones are ringing, the emails are coming in, and we're doing transactions. So I want to say on the positive side, we're not going to talk about all the chaos out there. We're going to talk about empowering you and using the tools that are out there to get you where you want to be. But like I said, the only dumb questions was not asked. The PowerPoint for this will be uploaded at a later time today, and if you are in a situation where you happen to be right now, I think we're just set up for Oregon CE for real estate. If you're a broker, you can check in with Celia Moore, cmoore@1031exchange.com. Her information's on the last slide, and she'll be sending out certificates for people that qualify for that or need that. So without further ado, we'll get started. And thank you very, very much for joining us today. We've got a good turnout, 80 some odd people, I believe. So should be fun. I wish I was in front of a room seeing all your smiling faces, because I missed that. And it really, the energy is just something that I don't, feel when I'm sitting here in front of a computer screen. But anyway, thanks for joining us. And here we go. If I can get the next slide to go. My background was real estate investment, and I moved to Oregon in 1990 to buy some property, and it was sort of interesting. My first exposure to 1031 was actually through my father. He happened to be a dentist. You're going, well, how come a dentist is talking about 1031s? He didn't know anything about it. Actually, it was down in Santa Cruz, California, and he actually had two different patients in the early mid 80s that had exchange companies, which is sort of funny because there just weren't that many of them at the time. But one of the guys owns Starker Services, and he's a great friend. He's sort of my mentor, a guy named Ron Stash, and we've done so much through the years, and just a wonderful person. And early CCIM, and then we've got a variety of things that I've learned with him. But the bottom line is we look at 1031 and we look at it, and as I said, I learned from my father, and he just said, well, he happened to mention it to Ron and then his other client that was with a company called Equity Preservation at that time. So it was funny because my dad had a property and he was thinking of giving it up, and he knew he was going to get hit with taxes. And so I think Ron said something to him about, hey, you ought to consider an exchange. And Dad's typical response at that time, and this is a long time ago, was, well, how am I going to find something that, somebody that has what I want, I have what they want, it's mutually beneficial. And obviously that's a rare deal, and that's the way we used to have to do it. You probably, if you've been in real estate for a long time, you've probably seen that picture in the closing room. It's a rowing shell with all the different closers there, and it's okay, 1, 2, 3, close, and the rowing shell collapses and breaks because you're talking about accommodating transactions, exchanges, and a series of things that all had to happen at one time. And as you all know, getting one deal closed is a tough thing sometimes, let alone getting a dozen of them that all have to happen at the same time. So when accommodators got in the biz and or created a different avenue where we're just using a paid accommodation to structure an exchange, it totally changed things. But the bottom line is we do this. We always talk about 1031s as maybe the most powerful investment tool out there. And I think it gets lost because people just use it today as something, we'll just think about it at closing. I think if you do that, you're really doing yourself a disservice. You're not going to get yourself where you need to be, or you're not going to give yourself all the options. And what I mean by that is, imagine today, and we've got people on the call from all over the country, but so many regions these days. If you want to go, you think about the Obama administration talking about shovel-ready projects. How long does it take you in today's world to get a shovel in the ground? If you buy a piece of dirt, get something going. So keep in mind the biggest headache with any exchange is you've only got that 180-day timeline to get things done. And obviously it starts at settlement of the first transfer. But that stuff goes, if we go back 20, 30 years, we could do an improvement exchange, build some, we could buy a piece of dirt, get things, planned, permitted, and get going on it and work. Today, the reality is so many places in the country, it just takes, months or years to get a shovel in the ground. And it's just not, something that can be done. But we're doing lots and lots of improvement exchanges where we're actually doing what we call leasehold improvement, where we're actually creating new improvements, literally new real property on property that's already owned. And the benefit of doing that is we've got time. You've got a piece of property, you can go out there, talk to your architects, engineers, talk to the planning department, get everything ready to go. And then when your property sells, or simply when you're ready to get started on it, we can do that project. So that type of thing really, empowers you, but you can't do that if you call us at settlement. So, the idea, a lot of times people ask when I want to hear about an exchange. I'm going to say, well, when you contemplate a sale, but ideally when you buy it, because when you buy the property, you're probably going to sell it at some point, and you've got to understand how you own it's going to dictate a different course of action. And we'll talk about that briefly. That vesting issue, partnership exchanges are strictly prohibited from 1031 treatment. So we have to create some type of vehicle that's going to get it. And typically, we're looking at partnerships. We're going to be breaking the entity and letting people go different directions. So it's a drop and swap or a swap and drop. But that's a whole nother seminar. You can give us a jingle if you have questions on that stuff. But the bottom line is, if you look at this slide, it's talking about people do this. And the great thing, we've got two businesses in here. We handle tax deferred exchanges with tax money and with qualified money. We have a company called IRA Advantage that does self-directed retirement accounts. And I honestly am not a big fan of retirement accounts because you put the money in there, when the money comes out, you get taxed at normal tax rates. And so you don't have the ability to do things like, for example, if you go out and buy a piece of property, you just kick that tax liability down the road. And if you do it till you swap till you drop, it all goes away. So it's really a nice thing. Worst case, you're looking at long-term, well, worst case, you'd be looking at normal income tax, but typically you're looking at long-term capital gains tax treatment on things. So it's one of those things where I just love real estate and 1031. It's not something to think about. It's not a really a tax decision or a legal decision. It's an investment decision. You're choosing to do this thing. You're choosing to keep your money working for you until at some point you do something else with it. And today's presentation is talking about giving yourself or giving your client a place to go. And the idea, think about buying a car. Everybody focuses on what they're going to pay for the new car. What happens to the value of the trade-in? So if you're a broker out there, have you ever had somebody think their property is worth more than it was? And if you find them the perfect replacement, are they more or less likely to give up that thing? And I'm the same way. If you get me excited about buying something, that's a lot of fun, buying that new shiny object. And a lot of times the old stuff is something, well, yeah, now you got to get rid of it to go do this. And there's probably other people out there. My wife always gives me a hard time. She said, before you bring more stuff in, get rid of something. So, the exchange is just that conduit out of what you don't want into what you do want, keeping your money yours. And the bottom line is, real estate investors, as we say on this slide, just look at it. You spend your whole life deferring tax. At some point, you don't want to pay that tax. Or maybe it is just a situation where you're looking at the most opportune time to do it. But the idea is, this is something that's elective. You can do it for as long as you choose. You're not stuck with it, and just keep it working that way. But the bottom line is, we're going to do what we can to keep your money yours, keep it working for you. And at some point, you've got a variety of menu options that we're going to talk about today at the end of the day. So a lot of times people say, well, hey, I'm going to have to pay the tax at some point anyway. Why not pay it today? And for those people, I always ask them about, well, do you have an IRA or 401k? If so, why? I mean, you're going to pay the tax at some point. Why not pay it today? Taxes don't go down typically; they typically go up. The benefit later, obviously, is we've got inflation on values. But you've got to look at your situation, understand where you're going with things, and really a lot of times we'll have people call up and then they want to do something, want to force something into an exchange, and we might tell them, hey, it's not the right thing to do too, because you don't want to put your life on hold to appreciate it, right? I mean, we all have a situation where you're here today. Where do you want to be in 2, 5, or 10 years? We're going to help you get there. But give us a call, ask us the questions. We'll do what we can to help you out. I am not really going to cover these extensions. It's something where we're really nearing the end of what's effective. But if you are in an exchange, or you've got clients in an exchange, this slide, the next slide is sort of an easy overview. This one, extension, who's it help, gives the brackets, who it impacts, what's going on. And if you're not familiar with this, as I said, I've been doing this for 30 years. I've been handling exchanges, using them for longer than that. But the idea is that we had never, ever had an extension for anything until 9/11. When we had 9/11 happen, we had extensions. Typically, the extensions are regionally driven. If you can document your transaction was impacted by a catastrophic presidentially declared national disaster event, then you're going to be entitled to some type of extension. This is the first time we had one that was literally nationwide, but it's a very tight scope. And I don't know, we in the industry are actually expecting something more, but who knows? There's so many other things going on right now that are impacting us. So the relief that we were issued is described in these 3 slides, and hopefully we're going to have something more. But if not, this is what we're looking at this time. If you or a client is involved with a transaction currently, this is what you're looking at with respect to any potential extensions. So why real estate? And think about it. I get up in the morning. My wife gives me a hard time because I get up and I turn on the news and look at what's happening with Wall Street, and then I go out and work out and do my thing and come back into the office, and there I go. But we've got a situation where you've got with Wall Street, things go up and down all the time, and the old saying, you never buy or sell on news, but everybody does, it seems like. And so you've got that instability of the market. And you think back about 20 years now, we've got all those day traders, and I guess people still do that stuff, but literally you've got things going back and forth. Real estate, people knock it because it's not liquid. Well, the illiquidity also adds stability. But the great thing about that real estate is it doesn't have to go up. As I said, we handle retirement accounts. Also, we have lots of people. We've all heard the ads for tangible assets. We've all heard the ads or watched them on TV. Hey, buy gold, buy silver, do this, do that. It's an inflationary hedge. Well, you buy those precious metals, and we do lots of retirement accounts for people that want to do those things and diversify into metals or some other tangible asset. But and for the most part, they're coming to us because they want to go buy real estate, the ultimate tangible asset. But the thing I love about real estate is it doesn't have to go up to make you money. Even if you buy gold or silver, you're betting that it's going to, or the inflation is going to drive it that way. But with real estate, we've got cash flow, leverage, interest deductions, mortgage pay down, depreciation, appreciation. At the end of the day, you get to choose whether you want to pay the tax on the disposition or you do an exchange. That statement right at the bottom in the middle, real estate is real investment. If we look at the investment world or the Wall Street world, what do they consider real estate? They consider it an alternative investment. And you know, even the association that works with let's say whether we're talking precious metals or real estate, you know, that association is an alternative investment association. They even call it that. So I don't like it. I like to say real estate's a real investment. How can you say that potentially one of the oldest investments in the history of mankind is an alternative investment? We've got, you know, what got us into the problems during the crash? Synthetic derivatives, those are real, but real estate's not. So I'm going to always reference real estate as a real investment. And that's just the way I look at it. So take that. I made a comment earlier. When do I want you to think about a sale? Or when do I want you to think about an exchange? I'm going to tell you, anytime you look at a listing, if you're a broker, this slide, I just throw it in front of a taxpayer and say, okay, what are we selling here? And I guess I'll take it a step further too, because what do you really want this thing to be? If we look at most real estate dispositions are going to fit under either Section 121, the universal exclusion for the sale of a home, or Section 1031. Investment properties. 1033 is something that applies also, involuntary conversion. You got to love the lawn mowing behind me. I hope you guys can hear me. But you know, if you look at things and you say, okay, what's going to fall outside of 121 or 1031? 121, for a property to qualify, you have to have lived in it for 2 out of the preceding 5 years. It's not what the property is at time of disposition. It's whether it's fit that 2 of 5. So you might have had, a lot of times people's first investment properties, that rental or that their home that's converted, you know, maybe they outgrow it and it's now converted into an investment property. Well, if you sell it within 3 years of moving out, you still are entitled to Section 121. You get outside the 3 years, now you're going to be looking at Section 1031 or paying the tax. 1033 is for involuntary conversion. That sort of fits in between. You know, we've got dealer property also, something acquired and disposed of, held for resale. That's going to fit outside of either one of these things. But we've also got a situation where you could have a single property with allocations Section 121 and 1031, or even, you know, resale too. So it really depends on what you're doing. Dealer status issues, anytime we're looking at dealer status, you know, we all hear the ads for flipping properties. That stuff is not going to fit 1031. And you know, my background was flipping, but I did not flip in that manner. I would buy, fix, rent, cash out, refi, season, and maybe a year or two later, I then exchange out of that property. What money I got via the cash out refi was typically going to be as much, or maybe in some cases more, than I would have netted after paying the taxes on the property, and yet I still had the asset. So I really like that, and you got to look at what's going on. But if you're looking at dealer status issues on a given property, you buy with the intent to, you know, fix and turn, that doesn't fit 1031. And even if you held it, even if it took 2 years to fix it before you turned it, if all you did was prep it for sale, you're looking at normal income tax, you don't fit 1031, and you're looking at normal income tax instead of long-term capital gains tax. So we applied the Clarkowski court case, and there's 9 points used to determine dealer status, and that's going to dictate whether something fits or doesn't fit. I also use that court case and those 9 points when we're looking at qualified investments, IRAs, 401ks, when we're looking at UBIT or UBTI issues, unrelated business taxable income. And we look at that type of stuff and then apply it to make sure we're not going to have a cross that line into tax exposure. Even with a Roth IRA, you can have tax exposure on leveraged investments. So, you know, as I said, the only dumb question is one that's not asked, so give us a call on this stuff. But when you look at something, whether you're the broker listing a property to sell, you look at this sheet. What's this thing want to be? And if you look at Section 121, it came into play in 97, and it was a different world then. If you look at the 250 exclusion or the 500 that Section 121 applies, it meant something in those days. It's still nice, but if you look at gains today on people's homes, there's so many people with homes that have gains well in excess of the 250 or 500. And I would say take a look at what you have if you're the property owner and what you want that property to be. Do you want it to be an investment? Do you want it to be your residence? And the beautiful thing about this stuff is you can convert an investment property into residential. You can go residential into investment. So we're just going to look at this stuff and once again work it out, see how we can keep your money yours and moving forward. As I said, you could have a single asset with allocations different directions. An example would be a duplex, half owner occupied, or if we're looking at a situation where we're looking at maybe it's a farm property. We've got the farmhouse and the working land, two different situations there too. But you take a look at the stuff and what's it appear to be, what do you really want it to be? Look at if you're the broker, look at the use, what you think's going on. Also look at the vesting of the property to understand what's going on. So that last frame was talking about converting assets and going back and forth on stuff. So the typical question, I hear this all the time, how long do you have to hold a property to have it qualify for 1031? And tax and legal people are just always throwing it out there. It's like, oh, 2 years, the code says 2 years. 2 years is what the code says for a related party transaction. And if you read the fine print, even in that scenario, if you can document there was no intent to avoid tax, even in that situation, there's not a black and white required mandatory hold period on stuff. So if we're looking at a arm's length transaction and something that you're not transacting between or for the benefit of a related party, then we're really truly looking at intent when you bought the property. There's absolutely no stated required hold in the code. If you ask me, I'm going to say a year based on two factors. One, the break between short and long-term tax rates on assets held for investment. Two, it's been proposed a couple times. But with that said, if you've got a home and the exclusion is not going to cover your tax liability on disposition, you've got a choice. You can pay the tax or move out of the property season as an investment. So the question is, well, how long do I need to do that? The other situation is maybe I want to exchange out of this pure investment property. I'm tired of dealing with the terrible T's, toilets, trash, tenants, turnovers. I just want to get out of that world and go buy a property at the beach to retire into. It sounds good to me. You look at that scenario, how long do you have to hold that property that you buy as an investment before moving into it? And I would, once again, recommend a year, at least different tax years, but ultimately that decision's not up to me. It's up to you and your tax people. So that's a conversation you would have with them. If you call me, ask me, I'm going to arm you with information to take to your tax people and you can discuss it intelligently. But your tax people are your biggest ally. You want to get good tax people. Number one, we're just one member of a successful team of investment people, along with brokers, obviously, management people, contractors, tax and legal people, finance people, escrow people. It's a complicated world today. So take advantage of the professionals, the resources that you've got out there, ask the questions. And if you look at things, what we look at with 1031 is intent. So you might have a situation where you bought a property, you bought your first rental property 6 months ago, and all of a sudden COVID hits, and maybe you were unfortunate enough to buy a property in Seattle or Portland or someplace where you've got the politicians telling the tenants or passing legislation that the tenants don't have to pay you. Well, nobody's helping the property owner. So you're sitting there with an empty bag now and you need to get rid of it. And somebody's saying, well, you can't exchange out of that property, just exchange into it. Well, that's not true. Your intent. You've got a totally different world today than you had 3 months ago. So if you got something and it's not working for you and you can't handle it or you don't want to handle it anymore, there's nothing in that code that says you have to hold that property. So back that team of professionals. My experience is you want that tax person working with you. You want them to understand what's being done. You want them to agree with you and plan with you. You want to plan for an audit that never occurs. And so ask the questions, work with them. If they've got questions, we'll talk with them. But once again, let's look at the situation. We're going to help you get where you need to be, hopefully. Basics, okay? I spend a lot of time wandering around the web like everybody on this call does. But it's funny because I see these postings, yeah, so-and-so's 5 rules. They came up with the 5 rules at 1031 or da-da-da, all these different things, 5, 6, 4, 3. Well, it's all personal opinion. We all have our positions on it. I like simple. I had a buddy that worked for me years ago, and the old KISS principle, keep it simple, stupid, right? So every time I get on a call with somebody or sit down with somebody, I'm going to start asking them questions, look at what they've got, where they want to go, and see how we're going to get them there. But when we look at the basics of an exchange, from my perspective, one, it's got to be an exchange. You sell something, you buy something, we step into the transaction before anything closes and create that exchange. The exchange is not between the taxpayer and the buyer or seller. The exchange is between the taxpayer and the exchange company. They give us something, we got to give them something back. We've got 45 days from settlement to ID what's to be acquired, 180 days to get the property, all the properties. You can give up one property, buy 10. You can give up 10, buy one. It really doesn't matter. It's wide open for you. But it's got to be an exchange. All right. 2, the items relinquished and received must be of like kind. The like kind definition has never changed. I don't have much hair these days, but 30 years ago I did. And I laughed because I'd met people in presentations. Well, I remember when it used to, and this one I had hair on my head, I remember when it used to be a house for house, land for land, all that stuff. And I have to say, well, it's never been that way. So when we look at like kind and apply it to real property, I shouldn't say apply it to real property because that's all we can do these days. We used to lots of cars, boats, planes, aircraft, businesses, everything else. But with the tax reform, we lost personal property, and I guess on the bright side we got opportunity zones, but they're really apples and oranges. But the idea is, the items relinquished and received must be of like kind. Like kind requirement refers to the nature of the investment rather than the form. Therefore, you can go from a rental house into land, into office buildings, apartment buildings, places to beach retire, into all those things are going to be of like kind. It's just got you're giving up property you've held for investment, you're acquiring something with the intent to hold for investment. That's what's important, right? 3, for total tax deferral, and understand 1031 is not all or nothing. 1031 is going to, you choose to defer what you want to choose to defer. It's totally up to you and your tax people. You figure it out. And by the way, anytime you're relinquishing a property, you're considering relinquishing that property, use that tax person, okay? Figure out what your basis is and your gain is if you sell that property. Understand what the tax liability is going to be. Then you're armed with information and do the right thing. But if you have no idea what your tax liability is, you're really just out in the dark. But and the other thing is that tax person, they like to know what's happening before April 14th, right? So keep them in the loop, let them help you plan, and take advantage of their knowledge. I mean, they're great resources, and you've got to understand what's out there. And if there's confusion, reach out. All right, but anyway, items relinquished received must be of like kind. The NAPKIN test says what we have to do to be totally deferred. And it's not all or nothing. So the NAPKIN test was actually started by a guy named Marvin Starr out of the Bay Area. And actually he scribbled out the formula on a napkin during a break, and that's why it's the NAPKIN test. But in a nutshell, you're just saying, hey, you need to go cross or up in value and equity between the relinquished and the replacement property. I would venture guess that anybody on this call that's been doing exchanges for a while has heard people say you have to replace debt in an exchange, and nothing could be further from the truth. That's one of the worst pieces of information out there. And the reason I say that is think about what happens in recessionary times. Okay, we have typically we're going to have a lower loan to value, and we're going to have tighter underwriting and all kinds of other things going on, or maybe you just can't get the loan. So anytime we're going in recessionary periods, I have people calling up saying, well, gee, I understand I've got to replace debt in exchange. I don't want to have any debt on the replacement property, so I guess I'm going to pay off the property that I'm relinquishing before it closes. That way I won't have to have debt. Totally unnecessary. You don't have to do that. So debt can go away 2 ways. One, by going down in value. The other is by adding cash to the transaction, okay? And you can always add cash. You can offset mortgage boot or reduction mortgage with cash. You cannot offset cash boot with additional mortgage. And I've got a page on each of these bullet points in a second we'll be looking at, so you'll have it all in black and white for a later date for future further reference. Finally, we've got continuity vesting. Anybody on this call that's done an exchange understands the toughest thing about any exchange is time. The second biggest issue is vesting. And that vesting issue, it gets more complicated today. Once again, we've got a situation where maybe you lost your job. I've had people quit their job in the middle of transaction. Well, continuity vesting just means the taxpayer that relinquishes has to receive. That can be difficult. Think of community property states versus non-community property states. For example, I'm sitting here in Oregon. A lot of people will start off with single property, then they get another, then they get another, then their lawyer says, well, gee, you've got all this liability out there. Let's shove them into a limited liability company. So a husband and wife in a limited liability company in a non-community property state, they cannot go in and out of the LLC through the exchange. So a lot of times what will happen is we set up the exchange in the LLC's name. The taxpayer goes forward, talks to a lender. The lender says, gee, let's do it personally, not via the LLC because the money's cheaper. Well, we can't do that. We can't make that change through the transaction in a non-community property state. Now we look at a community property state, we can go in and out of a limited liability company. So that's how easy this vesting issue gets to be a problem. So what's an exchange? You give us something, we give you something back. We can do a true swap. Honestly, you don't need us. A true swap would be a situation where you've got a property, somebody else has a property, they're a similar value and equity, and you want their property, they want yours. Well, that could be a true swap. Maybe you've got a smaller property, you want a bigger property. You could swap into the bigger property. You can do that as easily as just putting in the consideration on the purchase sale agreement that you're using the property's consideration. You're going to give that seller the property, and then you're maybe financing the gap or whatever. So you, the small property buyer buying the bigger one, you'd be fine in that situation. The larger property owner is going to have to structure an exchange through an accommodator, or they're going to have tax liability on the difference in the value there. But a swap is something, you've got something, I've got something, swap back and forth. A delayed exchange is what we typically see in this world. Delayed exchange, you sell first, buy later, 45 days from settlement to ID, 180 days to get it done. A reverse exchange, we buy first and sell later. Reverse exchanges, though, when we got to, and as I said, we've been doing this for 30 years, we used to do reverses in what we would deem a true reverse format, and we got the RevProc in 2000-37 is the RevProc on reverses. And that prohibited true reverse exchanges. So what they did is they gave us rules on warehousing or parking transactions, which I wish they would have gone the simple way, but it never happens. So warehousing just means that we're going to sit on a property at one point. The taxpayer cannot own both the new and old property at the same time. So we create a limited liability company that takes ownership of either the new or old property. So we use the warehousing for reverse exchanges. We use them in delayed exchanges. Maybe you took a property as partial consideration and you don't want that property. So if we gave you the property, you sold it, you would have held it for resale. So the property comes to us, we sell it, and when it's converted to cash, we have the balance of money go forward. That's a warehouse transaction. Improvement exchanges are warehouse transactions. Anyway, so we're going to look at swaps, delayed, reverse, improvement, warehousing. And I'm just covering these just to make you aware of this stuff. We're not going to be talking about reverse improvement type transactions. Say we don't have time during this call, but we do these presentations all the time. So you can look on our YouTube channel, take it out. Take a look there. It'll help you fall asleep some night if nothing else. But the idea is lots of information out there that can help things get done. So you give us something, we got to give you something back. Like kind, we talked about this. Any real property held for investments, like kind with any real property acquired with the intent to hold for investment. Absolutely no required hold. It's what you're doing with the property more so than the time. I want to point out that 10 o'clock button up there, or the picture of the building, build to suit, 30-year lease. A 30-year leasehold interest in real property constitutes ownership of real property, or a lease with extensions to 30 years. So we use that structure when we're building on property already owned. We're literally building new real property that's like kind. Napkin test. as I said, this is not an all or nothing. So you choose to defer what you want to defer. And you might be in a situation where today, with what's gone on, you might have some losses. Maybe you had some stock losses that could offset the gains. So having tax liability is one thing, taxes owed is another. And that's once again why your tax people are so important. Look at your life and use them. Take advantage of their knowledge. You're paying them to do work for you. Use them. Not just do the tax return. Plan with them. Understand what's going on. But you're in a situation where maybe you have losses elsewhere that can offset the gains in this. And that's one of those tools. You swap until you drop, or you swap until it makes tax sense. Making tax sense is a situation where maybe you made a pile of money last year. 2020 is not working out real well for a lot of people. So you might have a situation where this year, hey, you can sell the property and you don't have to do an exchange because you can offset the gain on the property with a loss someplace else. Take a look at that stuff. That's why your tax people are there. But the napkin test, like I said, it's not all or nothing. It says you go across or up in value and equity. And as I stated earlier, you can offset mortgage boo with cash. You cannot offset cash boo with mortgage. If you want to pull some money out, you can do it. You're going to pay tax on the money or anything that's received that's not of like kind. That's considered boo. Boo could even be a situation you're reducing the value of that property. So it's not all or nothing. Buy what you want to buy. Just understand the tax liability and be prepared to take that on. Continuity vesting, we briefly talked about this, but usually we're talking about this in the context of partnership exchanges. But it does make a difference, obviously, community versus non-community property. Or in today's world, as I said earlier, we've had people quit jobs in the middle of an exchange. It's sort of hard to get financed if you don't have a job. More often than not, like right now, we're dealing with situations where people have lost jobs. So maybe the property was in one person's name, and now the spouse needs to come on because they can't get financed, they lost their job. And so once again, back to the tax people. We're going to look at, if you're a broker, take a look at when you list that property or you're contemplating that list, you get the trio, look at the ownership, the vesting of it, make sure it is what you expected it to be or what you think it should be. And understand that ownership or that actual deed doesn't necessarily indicate the ownership of a property. If I sell to you on a land sale contract, for example, I've got title of the property until you pay me off. If I sell to you on a note trust deed, you're going to get title. But that's just one example. You might have owned properties personally and you got married and you've been married for a decade now, you filed jointly. Well, even though the property is only in your name, you've both been enjoying the benefits and burdens of ownership. So you could add that spouse if you need to, through that transaction. But I shouldn't say through the transaction. You need to add them either at predisposition. So we're going to have them involved with the exchange at the onset. Or if you're adding somebody through that transaction, let's say for finance purposes, maybe it was just in your name, now you got to add your spouse and it wasn't done previously. Well, anything your spouse owns, you don't. The exchange requires you go across or up in value and equity. If you just put your spouse on title with you, whatever their ownership is not yours. So we need to make sure we're satisfying your exchange to, first and foremost. And maybe we can put the other spouse on as guarantor to the loan. If we can't, we've got to put them on title. Then let's put them on at 1% or something. Or if you're adding money to the transaction, they can be an owner to the extent that additional money is brought in. But if you're just using your money and you put your spouse on 50-50 with you on a replacement, you're going to have a big tax problem. So, that's once again planning things. And I always ask these questions in presentations, but if anybody on this webinar, flies an airplane, you file a flight plan, you even running a river, you're going to file a float plan, you scuba dive, you're going to, plan the dive the plan. So look at this stuff. Don't look at it haphazardly. Don't look at it as, oh yeah, I'm just going to think about the exchange when the thing's closing in escrow. Look at it, do yourself, a real service by working from the first contemplation of sale to get where you want to go. And you can do everything short of closing on something, before engaging us. But as soon as an escrow is open, make sure you get a hold of your exchange company, get things set up. But the bold at the bottom of this page, when buying an investment, plan for the sale. So, most of the problems we've got in this situation today are based on limited liability companies with groups of investors, and that group wants to go different directions on disposition. So that's going to look at, maybe you buy the thing tenancy in common instead of as an LLC, but then we've got lenders that, may or may not require these things too. So all these things we have to juggle, but it all requires time and planning. And if you take advantage of that, do the planning, and take the time to do it, you'll be in a good spot. But you just throw it under the bus and think about the exchange at close, we've got obviously an opportunity to have lots of problems. Timelines, 45, 180 days. Both start simultaneously at settlement. And if you're selling multiple properties, it would be the first one. And I just want to throw out there that you can give up one property again. I said earlier, give up one and buy 10, give up 10, buy one, or any combination. It's really wide open. The ID rules, actually one last comment on this page, 180 days. Is 180 days or the due date of the tax return. So you got to be very, very careful late in a year that you're not filing a tax return before you've completed the transaction. So anytime we're looking at transactions opening, in the October, November, December, we've really got to look at things because, April 15 comes around pretty quick. If you haven't completed your exchange, you need to file an extension, because if you file that return and you haven't completed your exchange, you've just terminated your exchange, and that's obviously not a good deal. So anytime you're looking at transactions late in the year, understand you want to complete the transaction before that tax return's been filed. Otherwise, you would have artificially shortened your exchange periods and potentially lost the transaction. In 30 years, I've only had one of those that I'm aware of where we had a person with a taxpayer with a problem, and it was unfortunately one of the brokers we do a lot of work with. His partner was taking care of the partnership return for this LLC and filed the return without talking to him. So our primary contact, our client, was well versed in this stuff, and unfortunately that happened. But typically just really keep this in mind late in the year, and take advantage of the tax people. Take advantage of them, use them, get the best you can get, best you can afford. Property ID. Now this page is one that causes people problems too, because they think, well, the ID rules, number one, you think all three have to be applied to a single ID, and that's not true. And the other thing is people just assume that these things are actually limiting you on some of, like, for example, a number of investors or not investors, properties. So you've got three different ID rules. Each rule works independently of the others. The first one says you can ID up to 3 properties of any value. Pretty self-explanatory. Second one, you can ID more than 3 properties. Total value can't exceed 200% of the relinquished property's value. That one's tough, but what are properties worth? And I had, before I was doing this professionally, I had actually it was right when we were first putting the company together, I got a hold of an audit manual, and it was asking whether a property was listed at the time of identification. Well, that's ludicrous. That's a totally irrelevant question. A property, number one, doesn't have to be listed to be bought or sold, but number two, it doesn't matter at all whether it's there. And the idea is, if it's not listed, that's fine. You don't have to have a broker to buy or sell something. So whether something's listed is totally irrelevant. Up to 3 properties of any value. Second one, you can exceed 3. Total value cannot exceed 200%. But the second part of where I was going with that is, what's a property worth? If it's not listed, what is that thing worth? So when you're looking at the 200%, you're looking at B or C, the 200% rule or the 95% rule. We're talking about valuation of property ID. And I would throw it out there, highest best use. My youngest brother is an MAI appraiser. That's the top of the heap. And I asked him one day, I said, well, Greg, how do you know you've done the right job, the good job? He said, oh, it's pretty easy. I said, well, what do you mean by that? He said, oh, nobody's too happy or too mad. When you're talking about off market valuation, for example, he does a lot of testimony and court case divorces and other things, and you don't have a situation where you've got a buyer and seller meeting of the minds there. So when we're looking at the Second, that 200% rule or 95% rule, we are looking at valuation, and it's not necessarily what something's listed at. It's what you're, what you're willing to pay for that thing, and make sure that fits. By the way, when we're looking at the 200%, we're typically going to look at the gross sales price on those things, and that's going to take care of it too. But second rule, you can ID any number of properties. Total value of the properties cannot exceed 200% of the relinquished property's value. Third rule says you can exceed 3, you can exceed 200%, but you've got to close 95% of the aggregate value of the properties you've identified. I know a lot of great brokers, but if I ask any one of them, hey, if you close every deal, they're just going to smile. Once in a while we have a sale fail, things don't work out, and that 95% rule is potentially devastating for somebody. You get outside the 45 days, and let's say you ID 10 properties, and you had one fall out. Well, if they were all the same value, you just lost 10%, and you just blew your exchange. So it's really important. Do what you can to minimize the impact of any of these, and what I mean by that is, back to the question, when do you want to think about the exchange? You list a property. If you're a broker and I came to you and said, hey, I want you to sell my property, and so you list it for me and you put it on the market, and today's Wednesday, Friday, you get a cash offer, they want to close it a week from Friday. Well, your first thought was, hey, that's great. Now the problem is, if you don't know where you're going, you don't want it closing then, because you want all the time that you can get to find what you want to get. So that 45-day time period goes very, very, very quickly. You can change your mind anytime up till midnight the 45th day. But an ID, what you have to do is you have to provide an unambiguous description, and then you have to receive substantially the same thing. If you want to buy a condominium, it's got to be a specific unit. It can't be a unit of this complex. It's got to be a specific thing. If you don't have an address, a legal description could work. If you're buying half of it, describe the half that you're buying. And that's important. We have a lot of transactions where our clients buying out a tenancy in common partner of theirs in a given property. And in that situation, they're going to ID the portion that that person has, and then they need to acquire or receive substantially the same thing. All right. This is a very, very, very important slide today. Okay, and in today's world, we've got situations where people are maybe needing to terminate a transaction, or maybe they started the exchange and all the chaos has really put them in a bad spot, and now they want the money. So this is something where years ago we would, if somebody wanted to terminate an exchange, we would say, okay, that's fine, we'll give you your money. And the attitude was, well, the government is going to be happy to get the revenue. Well, in the mid-2000s, early mid-2000s, I can't remember the year at this point, the government came out with a ruling: if you don't, if the exchange company does not follow what's called the 1031 G6 rules, that not only is that person who received the money, their transaction no longer any good, and they didn't care, they wanted the money anyway. But the problem is our policies and procedures would be invalidated, and every exchange we do would then have a problem. So nobody, and I will stress this, nobody in the exchange world, if they handle exchanges and have been doing so and they're professional about it, is going to give an exchanger money outside of the 1031 G6 rules. So what does that mean? Basically, you cannot receive funds until you've acquired everything you have the right to buy. If you want to pull money out of an exchange, you can do it at closing. If you're going to do it at closing, if you're using us, for example, our assignment agreement actually has a provision in there that talks about if you want to receive any taxable proceeds, you're going to write in there how much, and you're going to walk out of escrow with that money. So that money is excluded from the exchange. The money comes to us. You cannot get the money for any reason until day 46. All right, because you've got the ability to ID things. You've got the ability to do all kinds of different things. But I will tell you, that 45-day period is critical, more critical than ever today. When you get to the 45th day, you're either committed to completing the exchange or take it out, kill the exchange at that point. And what I mean by that, if you're a broker, imagine this, or if you're an investor, you've got the exchange, you've got that 45 days, you get to the 45th day, you say, well, gee, there's nothing really out there I want, but I don't want to pay the tax, so I'm going to identify these properties just in case. So now you get outside that 45 days, and they're not any good. You don't want them anymore, but you found a property you really want. You can't buy it. Or think about opportunity zones. You've got that OZ, that opportunity zone situation. Well, have you read about those? You've got 180 days to get the money into that. So the OZ is not a fallback for 1031 unless you have not ID'd things. And then you're outside the 45 days. If you haven't ID'd anything, you're outside the 45th day, your exchange is done, you can get that money and you can throw it in the opportunity zone, or you can go buy something else. But it's critical that you understand no time you're going to get money prior to the 45th day. After the 45th day, if you haven't identified anything, then you can get the money. If you've identified properties and you don't acquire those properties, all that you've identified, you cannot receive the funds until day 181. So it's not a company giving you a hard time. It's literally 1031 G6 rules, federal guidelines that mandate we do things that way. So once again, we want to talk, we want to figure this stuff out, ask questions sooner rather than later. Don't sit on your hands until day 44 and then throw properties, at us. And by the way, the ID, when we close a property, we're going to send an ID pack, gives you the 45th, 180th days, give you the options, all that stuff, gets you where you want to go. But anyway, I'll take care of that. End games, swap till you drop. This is what I'm talking about. Give people a place to go. Swap until you drop. Simply stated, you exchange until you pass away. Somebody the other day was saying, I was talking about people passing away. He said, no, when you become an angel. So I like that comment, actually. Okay, so we're going to swap until you become an angel. Simply state, at that point, your heirs going to get stepped up based on current market value, and they could sell the next day and no tax exposure. Exchange into a retirement residence. Buy the property, hold it for a year or so, then move into it. Do not sell that property within 5 years. If you do, within 5 years acquisition, it's going to be a fully taxable sale. Even if you've held it for more than 5 years, you're going to have the Housing Assistance Tax Act to deal with. If you've got questions on that, give us a call. Exchange until it makes tax sense. We talked about that earlier. Maybe you had a great 2019, 2020's beating you up. Maybe you just sell and pay the tax at this point. Maybe you got losses elsewhere to offset the gains, so on and so forth. Exchange into a passive investment. DSTs, Delaware Statutory Trust. Really, I just sort of look at it as Wall Street, the IRS's gift to Wall Street, and your ability to sell property, real property. And the idea is DSTs or TICs, tenancy in common properties, they're passive investments typically. So with a DST, you can buy into a single asset, or it could be a portfolio of assets. You could buy it doesn't really matter, but you're typically buying a portion of something. So when you ID it, you need to identify the portion of that DST you're picking up. But it's DSTs, Delaware Statutory Trust. It's like a REIT, but REITs are not exchangeable. Some REITs are an UPREIT you can exchange into, but you're never going to get out without tax liability. The DST does. Tenancy in common is the way we've done things forever. TICs, institutional TICs got sort of beaten up during the crash. But they're there, and there's institutionally structured TICs, and the difference typically I see between the DST and the TIC offerings when we're looking at bigger investment companies putting those things together is DSTs are typically used for static things. You're buying a going concern, and it's doing what it needs to do. TICs are typically value add opportunities. You're buying something, you're going to have a cash opportunity, and then you're going to have a pop at the end. The pop's based upon what that sponsor's done to maximize the value of that asset during the time you've owned it. End games, page 3, installment sales, structured sale. These two things are the same thing. A structured sale is basically an institutionalized installment sale. So you've got an installment sale, be careful on that, because when you sell on an installment sale, a lot of times people say, well, if I didn't get a principal payment, I don't have any tax liability. If you've got depreciation on an asset or debt on an asset, you sell and carry a note, you're going to have tax exposure in the year of disposition for both of those things. You'll pay balance the taxes on the principal payments over time. The interest, you're going to pay normal income tax on those things. But the problem with installment sales, maybe you've got somebody that defaults, you end up with the property back, you got to worry about that stuff, or maybe you had a short-term carryback and now they're paying you off. You didn't want that to happen. Structured sales, an institutionally offered or structured transaction. You've got a third-party assignment company that's going to assume all the obligation to pay you. over time. Charitable remainder trusts. If you've got questions on CRTs, give us a call. Tina Colson in my office worked for a decade in that space, and she can talk to you about that. But there's lots of charities out there you can give a property to and have a very, very nice tax situation for that transaction. So CRTs are out there. That's a great in-game. Gifting. We've got lots of people that buy properties. Maybe they've got 2 or 3 kids. They want to go buy a property for each one of them over time. I guess my comment on that is the gift taxes. If you gift cash, you've got typically a $15,000 per person per year situation there. If you're gifting an interest in property, understand you're gifting whatever the equity is there. So be very, very aware of that. But the benefit of gifting a piece of property, if you're gifting a minority interest, you can actually discount that gift by up to 40%. So imagine that you can do a lot of transfers while minimizing the tax obligation with that in-kind stuff. But we use the same process when we're taking distributions from retirement accounts, taking minority interest, discounting it, and it's just a huge tax opportunity there. Improving property already owned. This slide basically we could sit here for a whole hour talking about this. Bottom line is understand it can be done, and what we're doing is literally taking the proceeds from a property you didn't want, and we are creating an LLC that's taking a leasehold interest in the property you want to improve. We take the proceeds, do the improvements, and convey the leasehold improvements back to the taxpayer. Once again, this is something that's very attractive these days because you've got time to plan, permit, get it all ready to go, and hit the go button and get whatever you can done in those timelines. Few examples and we're out of here. All right, and I'm running out of time. I always do this, and people in my office laugh that I try to get so much into such a short period of time. I just get excited. I like these things. So, situation here, be aware, okay? Be aware of what's going on there. Understand with the CARE Act, we had some situations come up where CARE Act gives you a very, very unique opportunity to get up to $100,000 to use from your retirement account for up to 3 years. My advice for you in this situation, if you take the 100 out, you probably ought to put 30 or so away somewhere, because if you don't get the 100 back in, you're going to pay taxes on that fund, on those funds. But historically, we've used the 60-day rollover with retirement accounts maybe to fund a reverse exchange purchase. Well, maybe this 100K is going to give you the ability to do that reverse or do something else, fix up a property. But understand you've got access to funds for a period of time now. Use that access. Obviously, this slide is not something we've used historically because we didn't have the CARE Act, but we have used it with the 60-day rollover with retirement accounts. This was one where, once again, how do we save properties? This guy came to this was one we did during the last crash. The guy developer had a property. He was having problems with it, like everybody. Obviously, he was having a hard time getting anything done in those days. So he's going to lose the property. He was concerned because he was getting behind, and then the bank. Not only was he having a problem, but the bank itself was having a problem. The bank goes away. He was going to lose the loan, lose the property. Everything happened. So he called up one day and said, "Hey, Dad's got a retirement account. It's got a couple million in it. Could I use Dad's retirement account to pay off this property, save it?" And the answer is no, you can't just borrow money from Dad's retirement account. That's a prohibited transaction. But what we did in this situation was create a new limited liability company. Junior threw the property in there, received a membership interest attributable to his equity in the property. Dad's retirement account put cash into the LLC at the same time. Now who owns that property? The property is owned by the LLC that now has the cash to pay the property off. So that's how we got around that. We did that in a number of situations, but we don't have to do it just sell a property. We can do it to improve a property. So you can jointly own a property with your retirement account if you want. And that might be the best way forward if you're having a problem getting something purchased that you really need. But once again, these things are all things that are possible. Ask the questions. You might be surprised. I did a presentation for the CCIM Global conference last fall, and the title of the presentation was "You Can Do What You Don't Know," and I just loved presenting that type of information because it just really to see an audience, see people's eyes light up, it's neat. So the other situation, 1031, what I say about the napkin test, not all or nothing. So in this situation, we had a deal where property was given up $3 million, property acquired. The target property is only $1 million. And you're saying, well, gee, 3 million to million. The napkin test says you have to go across or up in value. You're going to have $2 million in boot there. That's going to be a big tax hit. You are right. Their tax basis in the property that was relinquished was $250,000. They actually deferred the difference between the $250,000 and the million, $750,000 in deferred gain, saved them $250,000 in tax, even if they just bought at that $1 million level. So, as I said, it's not all or nothing. Buy what you want to buy. Just understand what the tax liability is going to be on the balance of it. So think of it this way: every dollar spent beyond your tax basis represents tax deferred gain. As I said, in this situation, the basis was $250,000. If all they bought was a $500,000 replacement, they would have deferred tax on $250,000 in gain. For them to be whole, they have to get up to $3 million. And by the way, when we're looking at the target numbers, typically what is needed to be covered, we're looking at the adjusted sales price net of closing costs, not the gross. And by the way, debt is not considered a closing cost. This, and I've got a good friend, Connie Rathbone, that's actually doing a presentation. We've done lots of work with her. She did a lot of workouts nationally on TICs, institutionally offered investments during the crash. And actually, we unfortunately had to deal with one of those just 2 weeks ago, still from the last time. But in a situation, if you lose your primary residence foreclosure, you've got tax relief there. On income properties, you don't, something called phantom gain. So if the debt on the property exceeds the basis, you're going to have tax exposure in a short sale or a foreclosure. So either one of those, whatever is larger, in a short sale, whatever is larger, the debt or the sales price is going to be treated as a sales price. If it's foreclosure, you're just looking at the debt. But in this situation, what we do is we would get involved pre-disposition. So we'd get a call, hey, the property's going to go away, and we would typically just do an assignment of that membership interest in the LLC. So when the property's foreclosed, it was ours, not the taxpayers. The date that assignment of membership interest occurs, that starts the clock. So, and you think, well, gee, you didn't get any money out of it. How can you have the tax liability, and how do you do an exchange? What we're doing in this situation is isolating the taxpayer from actual or constructive receipt of the debt relief, not any proceeds. And a lot of times what happens is you look at the tax liability on a foreclosure versus what is required, because you're going to have to go out and buy a new property, vehicle or greater, the value would be actually, whatever the debt was on that property. So, if you look at what happens, the tax liability might be greater than what is needed to come out of pocket to go buy a property. So the question is, do you want to lose a property, get nothing, pay tax for the pleasure of losing it, or go out and buy something, at least get something with that money that would have been lost? Last example, this has nothing to do with 1031. So I'm throwing you a curveball. I just like it, and this is an opportunity. Think about situations with retirement accounts, 401k plans. Typically, you can't get money out of a plan until you're 59 and a half. Now, previous employer plans you get access to. Unfortunately, we've got lots of people calling us that have lost their jobs. On the bright side, they've got access to that money now, and they can use it to diversify into what they want, or they can even do business startups, and it's called a rollover business startup. In this situation, a husband and wife came to us. They were retired. They wanted to buy a mobile home RV park, and with their retirement account, so we're going to do a checkbook IRA. And in a nutshell, what a checkbook IRA is, we're going to create self-directed custodial accounts for each of their respective accounts, then do an IRA-specific limited liability company. The investment that the trust company makes is in the membership interest in the LLC, and that LLC has as its member the trust company. The manager is the taxpayer, and as manager, they've got the power of the pen, so they just go buy and sell things using the LLC. Well, that works for passive investments, things that they're not going to use. But in a situation like this, they wanted to be the on-site managers and be compensated. Well, that's strictly a prohibited transaction if we're looking at IRAs or 401ks for that example. But if we do this rollover business startup, we created a new 401k plan, moved their money into the plan. The plan that we also created a C Corp. The plan bought the Corp bought the park. And these people ended up with an investment, a place to live, and a job all in this one transaction. So I just love this. And I think it's a good bailout for people that have been lost jobs or in a bad situation right now. Bottom line, it's common for potential clients to state, I'm going to have to pay the tax at some point. Why not pay it today? You know, as I said earlier, you're looking at with anybody with an IRA 401k, they've got that same situation. So why are you doing it? But you got to look at what you've got, where you want to go with stuff, understand the tax liability, and choose. It's up to you to pay the tax when you choose to realize that gain. 1031 is going to allow you to go forward, deferring the gain until you choose to do it. And that's its beauty. That's the power of it. It's like I said, it's not a tax or legal decision whether you do the exchange. It's an investment decision. What's the highest, best use? What are you going to do with it? Where are you going? I'm going to take a quick look at our questions and see if anyone's got something. We're wrapped up with the actual presentation at this point. If I don't see questions on here now, what we will do is address them later. So I see this one. John, can hear and see you. Okay. So I've got one person who wants to develop a piece of land and want the owner to invest by holding the land until I entitle it and complete construction. I guess what I'd say to that, Paul, is we have lots of times we have a property owner that's not a developer, and maybe they want to be involved with a deal. Think about what I said with paying off that problem property. The guy that was going to lose the property, foreclosure, using his father's money, the father's retirement money, to actually bail the situation out. So a lot of times what we'll do is, and this is once again why you don't want to ask the question at the 11th hour, or just work with somebody that's handling the 1031 as a clerical function. There's just so much out there. What I do typically in situations like this, if you've got a property owner that wants to be part of a project, have them, they're just going to hold the property. Or maybe you create a new LLC, they're going to contribute their property into that LLC. And maybe if you're involved with it, you're going to contribute the cash, just as we used with the qualified money situation. We did a project a couple of years ago where we had the property was purchased by a builder developer, but actually happened to be a broker too. And he bought it, and he had another friend that was builder developer that was in an exchange. So we exchanged our client into the property. The property owner didn't have gain on the sale. So what we did in that situation is we had the property owner sell to our client on a known trust deed. Our client then went in, we did an improvement exchange, and that note between the property owner and our client's entity at a later date, that note was then converted to a membership interest in the LLC, which then had a joint ownership in that project, and nobody realized a tax obligation on that transaction. So if we're looking at joint ownership, doing things, we can always look at contributions and distributions of membership interest to get things going on. And like I said, a contribution into an entity is not going to trigger gain. A future sale obviously will. So a lot of times we're going to create, maybe we're starting the project, tenancy in common or convertible notes that end up going into an LLC. During the course of a 5 to 10 year project, it'll go from tenancy in common maybe into a limited liability company, and then maybe a year predisposition we go and tick the thing out again. But that's why you ask the questions, work on things. And Paul, I'd love to talk to you more about the project if you want to talk further about it at a convenient time later. But thank you all very much for joining us today. As I stated, if you've got a need for credit hours, please reach out to cmore@1031exchange.com. And all my best to everyone out there, best of health. And if we can be of help, please don't hesitate to reach out. and look forward to seeing your faces again in the near future. As I said, it's just more fun to be in front of a room. Thank you, and all my best. Take care, and I look forward to talking soon. Bye.